The next panel is going to look at commercial real estate, and to moderate this panel is Escar Namirembe. Escar is currently serving as an investment manager at Gen Africa Asset Managers Uganda Limited, and she's a seasoned professional in the banking and asset management industry in Uganda. Escar is officially our first female moderator today, so I expect a thunderous round of applause for her. Escar will introduce her panel. There'll be, I believe, one person joining us virtually.
As introduced, my name is Escar Namirembe, and on the panel today, we shall be discussing opportunities in commercial real estate. So I'll be joined by three individuals. One of us will be online. I don't know if she's on already, but I'll start off by introducing the members who are here. I'll start by introducing David Mwaura from Bora Africa, and Matthew Rukaari from NSSF Uganda. So as they come on, I'll be checking to see if Michelle Wanjiku from Acorn Holdings is online. So as we wait for Michelle to join us, I will ask David to introduce himself and Bora Africa as well.
Thank you, Escar. Hello, everyone. My name is David Mwaura. I'm a board member of the CFA Society of East Africa, and my day job is at a fund called Bora Africa, where I'm the finance director. So Bora Africa is a private fund. We invest in industrial real estate all across Africa. We are a subsidiary of a company called the GREET Group, the GREET Real Estate Income Group, which is actually a company that is listed on the London Stock Exchange and also listed in Mauritius. But at Bora Africa, we are private and we invest in real estate all across Africa. So industrial real estate, by that I mean we'll invest in logistics centers, we'll invest in factories, we'll invest in big warehouses, we'll invest in data centers, and also we'll invest in BPO facilities, business process outsourcing facilities. Thank you.
Thank you, David. Most of us in this room are, aware of NSSF Uganda, but I'll still ask Matthew, who is in charge of the real estate. He's a portfolio manager under the real estate arm of NSSF, to just briefly introduce NSSF Uganda to the members in the room who are not familiar with it.
Thank you, Escar. Good afternoon, everyone. Gen Zs. Good afternoon, everyone. Thank you. My name is Matthew Rukaari. I'm a portfolio manager on the real estate desk at the National Social Security Fund. For those that don't know, and I don't think there are many that don't know, because our Kenyan friends also have NSSF back there. But for those that don't know, NSSF is a provident fund. It's a collective investment fund that collects pension money. It's a defined contribution fund that collects investment money, has the mandate to invest that money over the life of someone's working life, and at retirement, give that person a lump sum payout. So we obviously invest in the traditional asset classes, equities, fixed income, and real estate, and the non-traditional, which is the theme of this conference, the alternative asset classes. Broadly speaking, our portfolio is about 20.7 trillion assets under management as of the last quarter. About 79.1% of that is in fixed income, which is government paper across the East African region. About 13.8% is in equities. So that's public equities and private equity. Our breakdown on that equities space is 90-10. So it's 90% of that 13.8 trillion is listed equities, and 10% of that 13.8 trillion is in private equity, which is TDB Bank, TPS Serena, HFB Bank. Some people don't know we have almost 51% shares in Housing Finance Bank. And the Yield Fund, David Mwaura was here in the morning. We have a portion of money that he manages. So my role in the investment department is I'm a portfolio manager on the real estate desk. So yes, early in my career, I was a valuer. So I was the guy taking pictures of houses and walking around sites with a tape measure. And like many of you, at some point, I felt it prudent to begin my CFA journey, because I felt valuers in our space were lacking in their knowledge of the alternatives in the investment universe. Besides real estate, what do the financial assets have to offer? I felt to be a truly well-rounded investment professional, you need to understand both the financial assets and the real estate assets. Hence my foray into the CFA program. So that's it now.
So thank you, Matthew. I'll start with you. I think everyone in this room is a member of the NSSF fund. Okay, the Ugandans at least.
We hope so.
Are members of the NSSF fund. So at least we know your investor base. It's us, the regular employees in different companies. What I would like to understand more is that in the real estate portfolio for NSSF, what is the breakdown? Because we do know that there is residential properties, there is office space as well, but I would like to know what is the breakdown between the two, and what does the return look like overall when you look at your entire portfolio?
Okay, so I didn't give you the allocation to real estate. The allocation to real estate presently is 7.1%. And most people in this room will know that a pension fund is placed in the category of conservative investor, right? That it's prudent to have your strategic asset allocation skewed towards lower risk assets. Now, real estate is put in the bucket of slightly higher risk than traditional asset classes. Although we can have an argument, a debate after this conference about real estate versus public equities. Which one over the last 10 years has been truly high risk? Because if we go back to the definition of a deep market is one with many buyers and sellers, right? Right? Yeah, so there's price discovery because there are many participants in the market. There are many people on the buy side and the sell side. Our stock exchange, does our stock exchange have many buyers and sellers? And if it doesn't, then what's the true risk exposure if you put your money in Stanbic Bank? Something to think about after here. So to go back to your question, the 7.1% represents about 1.4 trillion. Within that 1.4 trillion is what we call investment property and work in progress. So investment property is defined as property you hold for either capital gains or income yield or both. So workers' house, for example, is an asset within the investment property bucket. We hold it for rental income, so rental yield, and every year, perhaps a capital gain. So every year, valuers come and tell us if there was any capital gain or loss. So within the investment properties space, you'll have workers' house, you'll have Temangalo land, Simbe land, you'll have social security house. That makes up about 900 billion of the 1.4. The rest is what we call work in progress, your capital investment in ongoing projects. Because real estate, unlike a bond, Muhammad will just buy a bond of 100 billion and that's it, invested. My 100 billion investment will come throughout a multi-year period. So in the work in progress bucket, you'll have Pension Towers, which is that tall building on Lumumba Avenue. You'll have Temangolo houses, 550 houses being built right now. You'll have Chanja houses, about 130 houses being built. You'll have a small commercial complex in Mbale. So that will be about 500 billion right now. So the return that real estate contributes to the overall portfolio will come from the investment properties. And over the last 10 years or so, real estate return, again, because the bulk of it for the longest time has been vacant land, which is also an investment property, but now its contribution to your return is capital gain. And capital gain is a function of your valuations every year. And your valuations every year are conservative, right? 5 to 8%. So overall, the real estate portfolio will have about 8% return presently. But once you convert that work in progress into actual investment properties, that return will now start to touch the double digits. Not quite at the same level as your fixed income, but I think we can all agree risk-free investments shouldn't be giving you 15, 16%. So yes, that's where we are.
Thank you, Matthew. I think we shall come back to that discussion on the return vis-a-vis what we earn on our government bonds currently. I'll move to David. So for NSSF, we know the investor base. It's us here in the room. What is the investor base for Bora Africa? Who invests with you?
Yeah, thank you. So currently, our investor base will be the DFIs. That's our primary investors. So we do have, the usual names that all of you guys are aware of. We have indeed tried to raise money from the local pension funds and institutional money all across the region, which has been a bit difficult, for various reasons, including the regulatory environment. But it's something that we are really, really working on. We are trying to raise this institutional money, specifically private capital from the likes of NSSF in Kenya, in Uganda, and across the whole region.
Thank you. So in the past, you've been doing this, I think, for a minute. So say Matthew is interested in the products that you have to offer, and he wants to know what the return has been. Could you give us a range in what it has historically been and what he should expect it to be going forward if he was to get a portion of that and invest with you?
Yes. So when it comes to returns, as Matthew mentioned, there is your income return, which is the cash flow that you actually get from the properties earning rent, and then there's your valuation gain. But just before I talk about numbers, I want to go into a bit of the profile. So the beauty of investing across several jurisdictions is that you spread your risk. So rather than having all of your geographical risk in one country, say in Uganda, if you're investing all across Africa, so for example, we have properties in Mozambique, we have properties in Nigeria, we have in Kenya, we have in Ghana, all across the continent. The beauty of that is that it spreads out your risk. So when one country is having problems, another country is actually doing very well. So that means that even if you have properties in that country that is having problems, it's sort of compensated by the other properties in the other countries which are doing well. So that really, really helps your returns. And then the other critical thing for our fund is that we are a hard currency fund. So we choose our tenants very carefully because we only do leases in hard currency, that is dollars and euros. So our typical tenant is a multinational, a big company which is actually able to have access to that foreign currency. So regardless of how the currency goes, I'm sure you guys saw what happened with the Kenyan shilling last year and part of this year. Regardless of how the currency goes, you're able to generate a strong return because you're still earning your rent in dollars. So basically factoring in all that, we are looking at at a return of 10 to 12% in dollars, not in local currency, in dollars, which is, and I think Matthew will agree, a much stronger return than what you mentioned.
Well, again, sorry.
It's okay.
It's what I mentioned was the portfolio return. Again, within the portfolio, you'll have the individual performance of, let's say, our Mbuya project, built for 17 billion, launched in December 2019, sold within the 2 years of COVID to get 26 billion. That's a 52% yield. Now, because you built over a number of years and sold over maybe 2 years, IRR will come to about 16-17%, right? So again, so our total portfolio return for real estate is dragged down by the fact that we have 550 acres in Bora, and its contribution to your return is what the valuer says the per acre valuation has changed by.
Okay. I get you. So Matthew, NSSF having been in this space for quite some time, it has built quite the experience. As a fund manager, we work with quite a number of pension funds that want to enter the property space. They don't have the same, should I say, financial power that NSSF has. What advice or what pointers would you give trustees in this room who would like their pension funds to venture into property?
I happen to be one of the trustees for our staff provident fund. So I've had the opportunity to see reports from different fund managers. And I don't know if by show of hands, how many fund managers here have some exposure to real estate? Your fund invests in some real estate. Okay, that's one. So most reports I've seen have 0% allocation to real estate. So much for diversification, right? We studied the CFA hard, and we are violating the first principle of prudent investing, which is to diversify your money across different asset classes. So the question I have for all of you is what are we waiting for? Let's say, I understand, are you waiting for the vehicles that will give you indirect exposure to real estate? Or should you be the ones that are creating those vehicles? Should you be the ones that are going out? If let's accept that you do not have the expertise to directly build 40 apartments, granted. But go find someone that doesn't have the expertise to structure a financial product. Walk up to them and tell them that your capital structure for the funding of this project is inefficient for the following reasons. You're borrowing from the bank at 19-20%. You shouldn't be, right? This is how you should structure. Let's say you have a the Mbuya project. Your total development cost is going to be 17 billion. How do you intend to finance that? Demonstrate to him why his plan is suboptimal and how you can bring in private capital from somewhere that will supercharge his returns and give him a better overall return. So my advice is go out and find credible developers and sell them on the dream of efficiently raising capital for successful, what you believe will be successful products. Now the next question then becomes, how do I know if those apartments will sell within the 2-year period that I've forecasted? That's when you also go and invest in professionals that will give you insight into the performance of the market. So your only job is to ask the right questions. So let's say you have a Knight Frank coming or a Bagene, whoever, a professional in the real estate space, and you ask him, I have a project, I'm doing a feasibility, this is the description of the project, this is the location. I need to understand the probability of success for the offtake of this project. So then deeper questions. What has been the absorption rate for products that are priced between 200 and 600 million shillings? Have him go answer the question about absorption rates, about the actual realized sales prices, not the listed sales prices. I want to know what the performance of Mirembe Villas actually was, of Pearl Marina in Garugo. I want to know what the performance of that project I drove by in Kololo. I had apartments are selling for $300,000. I need to confirm that. So ask him very specific questions that he has to answer. Then you come back and you do what you do best, which is come up with the financial models. You input assumptions on the absorption rates that you've been given by the professional in the field. You input the costs that have been given by another professional, that's the quantity surveyor. So your only job is to gather all the professionals in the room, ask them the right questions, and then do the due diligence on paper.
Thank you, Matthew. I think this topic on property would go on and on and on. I would like to open it up to the audience for those who have questions for David and for Matthew to be able to bring them forth at this point.
Steve Uganda is my name from West Africa. This goes to Matthew so the discussion around allocation to real estate for the other pension funds could be that they don't necessarily have appetite for development risk, but myself having had that experience, then it will be the need in terms of them rolling out these projects and getting their pension funds takers. Then initially they build a portfolio just based on yield before then being property developers. But I think it's also important for NSF, away from just focus on CRE, we're also looking at being a lead in master plan projects, mixed-use projects, focusing on new urban nodes, as opposed to be standalone either CRE or residential or industrial, but basically looking to be a leader in terms of developing new nodes. I don't know that is part of the focus. Lastly, just around green buildings and how then you intend to position yourself as again a leader in terms of having efficiency for your projects.
Thank you. My name is Rukaari. My question is regarding real estate investment trusts. And this will go to both panelists. The first question is, what are your thoughts on REITs? And then my second one is specifically to Matthew, because I think he practices within Uganda. David, I'm sorry, you also practice within Uganda. Feel free to respond as well. What would it take for REITs to succeed in Uganda and in the region as well? Because looking around, we have not been able to make any progress, and yet we know that property there's a high appetite for investment in property, but the price point for individuals to get it, individual investors to get it, is quite high. Thank you.
I don't see any more hands for questions, so I will request Matthew and David to respond to the questions.
Okay, thank you for the questions. I'll just go with the REITs one to begin with. I think REITs are really effective vehicles for real estate investment. We have had a few in Kenya. I practice out of Kenya, although we do invest all across Africa. We have had successful, a few vehicles. Unfortunately, one of them delisted, but we have had successful ones. The other lady who was meant to be on the panel works for Acorn, which, as you guys probably know, have a very successful REIT for student accommodation. So I think the goodwill is there, and I think the opportunities are there. I think the challenge that we've had with REITs is the legislation. There was some talk earlier that the legislation has been passed for REITs, but it's not necessarily very streamlined. For example, there's this whole split between a development REIT and an income REIT, which might not make a lot of sense, because for a development REIT to make money, it has to develop and then sell. Now, for you to sell, it means you have to have an offtake. You have to have someone willing to buy, and that might take some time. So, for example, what Acorn did in Kenya is that they have their development REIT, which develops the student accommodation, and then they sell it to their other income REIT. So I think that creates additional work, and also it creates a lot of costs in terms of administration of the REIT, and also for compliance. Being listed comes with a lot of compliance costs. So I think just streamlining that legislation so that you can have a REIT that can do both development and income and hold those assets, I think that will make things significantly easier. And when I look at our fund, we are structured like a REIT, although we are not a REIT, but we do both developments, and then we hold those properties and we earn the rental income. So we're not under any pressure to exit and sell. So I think that would significantly help a lot of REITs. I think that would be what it would take. I think let's try streamline our regulations. And also I think for the for people like pension funds who sit on a lot of real estate and banks, I think they should be willing to let go of that, because unfortunately that's not your core business. So they want to hold the real estate on their balance sheet, but managing real estate and building real estate and doing all these things is a lot of work, and it's not part of your core competence. It might be better for you strategically to put those into a REIT and have a professional manage it and do the new development. So I think there also has to be a bit of focus from the people who are holding the assets.
Okay, thank you. I'll start with that last question, since it's part of from Gladys. What would it take for REITs to succeed in the camp? So, like David mentioned, you have your income REITs and your D REITs. They say your REIT behaves more like an equity asset class, like an equity than real estate. And again, do we want that off the top? Do we want, say hypothetically, you had Workers House, Renzori Towers, Pension Towers, and some other A-class building put in a portfolio, and this REIT is going to distribute 90% or so of the rental income earned to the shareholders of the REIT. Fine, you have that, but remember that your income yields to begin with are not quite in the double digits, right? So for a real estate investor, your total return is a function of income yield plus capital gain. Let's assume, for argument's sake, my income yield, say, let's pick Pension Towers, is at about 8-9%. And every year, my capital gain is going to be 3 to 5%, right? So my total return for Workers House will be 12, 13, 14% max. Now, the capital gain portion of that equation is going to be a function of the trading volume of the REIT shares, right? You would hope that they trade quite close to net asset value. But in our market, the traders, in my opinion, my personal opinion, not the fund's opinion, there's not enough trading that's happening that will effectively have a steady upward capital gain of the share price over time, right? But what I do believe that would be successful is the D-REIT, right? Because you guys all have 0% allocation to real estate. If I told you that this is my prospectus for a middle income residential housing project that I'm raising funds for, so far there's a farm in Kenya called Mivida Homes that has been successful with lower middle-ish income housing. So Mivida is a farm that is a combination of Actis, the money side of the equation, and a developer called Shapoji, right? So the reason they've been successful in the D-REIT is because their motto is build and sell, just let go, right? And in this part of the world, it's not yet illegal to have accrued interest be yours. Effectively, if you gave me 20% down payment before I finished construction of the house, in a more developed market, the interest accrued on that 20% should be for the buyer of the home. But here, what you're effectively doing is subsidizing the developer. You're giving him cash to build. So, for argument's sake, if he got 100% of the money required to build, do the math for me. What's his IRR? He got 100% of the money. He didn't put down any money, and then he sold the product for 30% more than construction cost. What's his IRR? I don't even know what it is, no? Because he didn't put a single shilling down. He got all the money from the off-taker of the final product, right? So the reason I think a D-REIT would be successful is because, again, you have to be careful with which income class product are you building. The middle income in this country has real buying power, and all focus is on Kampala and Greater Kampala metropolitan area. No one in this room is dreaming of buying a home in Jinja or Arua. All of you want to eventually own a home in Kampala or Greater Kampala. So the demand for product in this region within a certain segment of the income is real. So if you guys went out there and found credible developers, and there are many who built decent products, and you helped them structure something and you sold them on the dream of a more efficient capital structure, right? It would, in my opinion, it would be successful. Should NSSF take the lead in structuring a REIT? Should we be one of the investors in a REIT? Perhaps both. Maybe if we took lead in and gave you guys the opportunity to partake in our next Temangalo 2 project, because Temangalo 1 is receiving so much interest. If we initiated Temangalo 2 and sold off plan, perhaps we could invite you. It's now public knowledge that we're building government offices in Bwewaja. We've signed a fantastic deal with the government. For those that don't know, the government pays close to 200 billion every year in rent at locations they don't own across Kampala. If they left Kampala and went to that location would now be making over 200 billion annually. So I'll let you do the math. So perhaps we'll invite some of you at the point we are ready to start constructing to partake in a fantastic commercial project. Thank you.
Thank you, David. Thank you, Matthew.
Sorry. Escar, sorry. The gentleman spoke about our appetite for development risk. Yes, it's slightly higher than the rest of you because I'm now part of a team back in the office. We have engineers, architects, quantity surveyors, civil engineers. The development team, I'm just one of them, right? So we have a vacant piece of land. Your first task is to come up with the highest and best use. So you're master planning it, you're pricing the product. And yes, we do have mixed use projects. Bora, for example, is the master plan for the entire 600 acres is a mixed use project. It has been green certified. It has its own wastewater treatment plant, and that water is recycled, and so many green spaces and things of that nature. And again, people tend to appreciate that. Temangalo as well is going to be green certified. So yes, we're taking a lead we're also exploring alternative technologies that are more efficient than your regular brick and mortar. And yes, we have close to 2,000 vacant acres of land. 490 in Temangalo, 823 in Simbe. The goal is to master plan all that, and maybe even at some point consider just subdividing, creating titles, creating infrastructure, and having the market come by 25 decimal plots. Why not? All right. Thank you.
Thank you, Matthew. Thank you, David. So what I'm hearing today is that this space, there's actually a lot of potential that I think the people in this room can benefit from. A lot of things to do on the REIT area that we can come together and work on. So that brings us to the end of this session. Thank you so much for being on the panel. We'll have a photo session, and then we'll move on to the next item on the agenda. Thank you.